Hello, welcome again. So in this video, we will discuss about the ratio analysis and why do we need to know the ratio analysis. We'll be discussing a little bit about that and what are the different ratios. And finally, I will show you how to calculate the ratios. Okay. So why do we need to know the ratio analysis? Uh, because just think that your sales. Your sales revenue is 100 million, okay, and your net income is, say for example, 20 million, okay. So it means that in comparison to your sales, your net income is 20% of the sales, correct? But think that someone has the sales revenue of 60 million only, and she also has 20 million of net income. It means that the net income ratio in comparison to sales is higher for this business. So you need to know the different ratios, okay? And there are many different types of ratios. The first one we are going to discuss about is the profitability analysis, the activity ratio. So one key to profitability is how well a company manages and utilizes its assets. The higher the ratio, the fewer assets are required to maintain a given level of activity, okay. And we have the common ratio: asset turnover ratio, receivables turnover ratio, and inventory turnover ratio, okay. So net sales and asset total average assets. So in comparison to your total average asset, what is the sales? And in comparison to your average accounts receivable, what is the sales? So we need to know about that. The average collection period, how quickly you can collect the receivables, the accounts receivable, okay. And this is the profitability ratio, their profit margin on sales, so net income over sales, return on assets, net income over total assets, return on equity, net income over average shareholders equity. And finally we have the liquidity ratio, current ratio, and acid test ratio, meaning how quickly you can convert your assets into cash. So those are really important. And just one thing I want to say, that you must have the current ratio a positive one. The positive current ratio means you have more current assets than current liabilities, okay. And it is always preferred that you have the current ratio of more than 1. At least 1.5 is good. 1.5 current ratio is always good, okay. And let's solve one problem. So here is the problem. You can see that, okay. So we have the different accounts, and sales, assets, receivables, cost of goods sold, inventory, net income, shareholders equity, total current assets, total current liabilities for 2 years, 19. Okay. So what I'm going to do first, let's calculate the average. So this one plus this, it means divided by 2, okay. So this one is the average, okay. So we have the average one like this one. Okay, so we have this, and now let's calculate the ratios. Asset turnover ratio, what is that? Net sales over average total assets. Okay, it should be equal to net sales, say for 2020. Okay, let me see. So 2020 ratio. Okay, so net sales, it should be equal to net sales of 2020 divided by average total assets. So total assets is this one. So this one, 49.5%. Then receivable turnover ratio, it means net sales over average accounts receivable. Okay, so it should be equal to net sales again for 2020 divided by the average accounts receivable. So accounts receivable average is this one. Okay, this. So 1.16 is the receivable turnover ratio. Then we have inventory turnover ratio. Inventory turnover ratio is equal to cost of goods sold and average inventory. So cost of goods sold we have for 2020 this one, and average inventory. So average inventory is 22. So this one is 5.9, almost 6. And this one, average collection period. So it is 365 divided by receivable turnover ratio. So we have the receivable turnover ratio, this one. Okay, 1.16. So 312 average collection period. Meaning in 1 year you are collecting almost 312 days. Okay, and profit margin on sale is equal to net income, net sales. So it should be net income divided by net sales. Okay, this one. Then return on asset, net income. What we have done? Yes, return on asset, net income, and average total assets. So it should be equal to, so net income and average total assets. So the average total assets is this one. Okay, and then return on equity. So it should be equal to net income. So again, net income 80, and shareholders equity average is 24. Can you see that? This is the 24. Okay, 3.33, and current ratio is equal to current assets over current liabilities. So equal to, so total current assets over current liabilities. So this one 1.6, it is more than 1.5, so it's good one. And acid test ratio. So to calculate the acid test ratio, we need to calculate the quick assets. It's also called quick assets. So it should be quick asset is equal to, see that, total current assets minus inventory. Okay, this is the quick asset. So what we need to do, quick asset divided by current liabilities. This one. Okay, this is. So these are the ratios we have calculated, and let me format the cell number. Okay, it's better now. So that this is how we calculate the different ratios. I hope you have understood and what are the ratios means. Thank you so much.